All right, guys, so how does a HELOC work? One of our most popular debt weapons. We've talked about the strategies that one can utilize to make the most of a HELOC, especially when you want to do accelerated debt elimination or how you want to invest, whether it be in real estate or businesses or elsewhere. So today's episode, what I want to do is take a look at how a HELOC works and all one needs to know about this much beloved debt weapon. So we're going to start with what a HELOC is before we dive into how it works and what you should expect once you actually have one. A home equity line of credit, or a HELOC as the acronym, is a loan that allows you to borrow against the equity in your home and have the equity unlocked in cash with relatively low interest costs or rates. A HELOC is a revolving line of credit operating similarly to a credit card, meaning that you can continually draw on it over time as you pay it down. Anytime additional funds are needed, then you can use them rather than receiving another loan in one lump sum. Home equity lines of credit have a drawing period, which is defined as the amount of time that you are allowed to actually draw against the availability on that credit. This drawing period varies between 5 and 20 years typically, with 10 years really being the most common. This really makes home equity lines of credit an attractive way to access equity in your house, since they provide access to large amounts of money for long periods of time, which can be tough to find elsewhere. So your home equity is the difference between what you owe on your mortgage and what your home is worth. So for instance, if your house is worth $500,000 and you owe $300,000 on your existing mortgage, there is $200,000 in equity inside your house, which you might want to use and take out inside a home equity line of credit. Lenders generally want to see you have at least 15 to 20% equity in your home, along with a good credit score of 700 or higher, as well as a lower total debt balance or debt to income level. 85% is the maximum borrow amount, and HELOCs are secured against your home. There are obviously exceptions to that rule, but that's typical, meaning that if you are behind on payments or you're delinquent on the loan, your property can be foreclosed upon by that new lender who would be in second position behind your first. Now, many homeowners use HELOCs to cover big life expenses. They can be used for home repairs, updates, large furniture purchases, paying regular expenses, college tuition. If you're familiar with this channel, then you know that we deploy home equity lines of credit a little bit differently, from strategies like paying off a mortgage in as little as 5 to 7 years, to using HELOCs to invest in real estate and build a portfolio. So we're gonna be putting some links in the description for you below so that you can take a look at those videos and see exactly how we might use these tools and how that might suit your goals. As promised earlier in today's video, let's dive a little bit deeper into what you should expect once you have a home equity line of credit. Let's start with the draw period. To put it simply, a HELOC draw period is a timeline or time frame in which you're allowed to draw down funds on an open credit line. When your draw period ends, your credit line is closed and you can no longer take out any more money from that line of credit. After the draw period has closed, after say 10 years, the next phase of your HELOC is called the repayment phase, and it typically lasts for 20 years. And this is when you're required to pay the interest plus the principal, but cannot borrow any additional funds. Now, you can continue to borrow at any time and repay at any pace, meaning you could borrow all of it and pay it all back within a matter of days throughout that 10-year draw period. Now keep in mind, while the length of time your HELOC is drawn will never change, HELOCs are subject to fluctuating interest rates. Very important to understand that they are adjustable rates within home equity lines of credit. So your rate will go up or down depending on what's happening with interest rate trends and the overall economy, meaning you need to have plenty of breathing room inside your budget in order to account and handle the monthly payments that might be going up. During your draw period, you're gonna have continuous access to your funds if needed. If you don't need them, you don't have to pay interest, meaning if you had a $100,000 home equity line of credit, then you could draw anywhere between zero up to that $100,000 versus taking all $100,000 like you would in the form of an installment loan. One of the biggest perceived benefits of a home equity line of credit is that you can just pay the interest for the duration of the withdrawal period. So keeping your payments much lower at first than other loans you might pay. Right now, I have a $225,000 home equity line of credit balance off of a $250,000 availability. So I've used all but 10%, and my current payment on that is roughly $1,000, even with interest rates being much higher now than they were 9 months ago. So $225,000 with a $1,000 payment is not bad compared to other loans that I could be paying against. So that really means that you could have access to cheap money for up to 10 years or however long your draw period ends up being. I'm going to go ahead and include what we call our debt weapon cheat sheet. We never used to give this away. We've now given it away on 3 or 4 videos over the past couple of months. It's one of our best kept resources because we created it in order to help you ask the right questions when you get on the website of lenders offering HELOCs, or whether you get on the phone and start talking to a representative at the bank, a banker, a personal banker, individual at the credit union, etc., in order to fill in the blanks on that debt weapon cheat sheet. And that will help you ask the right questions related to not just this home equity line of credit, but any potential loan or debt weapon instrument that you choose to apply for moving forward. So that's our gift. Go ahead and you'll find it in the description. I'll put a link in there so that you can go ahead and download your own debt weapon cheat sheet. Use it at will. We won't come back and charge you for that at all. We do use this in our coaching program regularly, and it is a phenomenal tool. Is similar to really teaching you where you can fish and find great fishing holes versus me saying, go to this bank or that, because by tomorrow, that bank tool that I just steered you towards might be gone. Right now, there are some really great home equity lines of credit that have been around for the last couple of years. So certainly be sure to do your homework using that debt weapon cheat sheet and do your research. Typically speaking, you're only going to find these home equity lines of credit available on primary residences, the home you actually live in, reside in. If you're trying to get a home equity line of credit on a non-owner occupied investment property or a rental property, typically it's going to be much more difficult to come by, although there are exceptions to all of those rules. And typically you can find a very small number of banking institutions or credit unions that are offering those. Up until recently, Penn Fed Credit Union was offering one. I know that. That's Pentagon Federal Credit Union. So do your homework. This is what the debt weapon cheat sheet is for. How can you access the funds in a home equity line of credit is often a question that we get. Most lenders and banks will give you the ability to log in online and manage your account electronically. You're able to use those funds with a credit card or a physical check in most cases. It should go without saying that you should keep an eye on your home equity line of credit balance and your payments on a regular basis, because it certainly will pay to stay on top of this stuff, especially with the interest rates fluctuating so much, obviously then affecting your monthly payment, and that would then be going up too. It's good to keep an eye on your credit overall, really, since your HELOC is an open credit line. You're going to have to carry a balance on that for years potentially, and that will affect your utilization ratio, thereby affecting your credit scores. So your credit availability compared to how much you're borrowing impacts 30% of your Fair Isaac FICO credit score. So the lower the utilization ratio, the better, and your scores will be affected less and less as that balance is coming down. So it's recommended to keep your utilization ratio in general below 30%. That's a good milestone to shoot for in order to avoid negative effects to your credit score. But honestly, every percentage point reduction is a positive to your credit. Now, if you go back and you review the videos that we have on this channel, what you're going to find is that we're not often using home equity lines of credit the same way that many people are. We don't recommend paying minimum payments as your total amount paid. And of course, you'll pay so much more interest as a result of that over time. This is why we should avoid paying only minimum payments on our home equity lines of credit. You'll eventually be facing with the harsh reality that comes when your repayment period begins and you're required to start paying both the interest and the principal over that 20-year amortization. And that's if you're only making the interest-only payments on the loan. So what we are here to do and what you need to be prepared for is to understand and implement how you can substantially increase how much your payment going into that is. And you can fluctuate that payment based on the amount of cash flow you have. We either call this cash flow parking or even income and rent check parking. The paycheck parking and income parking process means that you're able to put all of this money against that balance and draw out it as you need it. It works as almost a replacement to your inadequate checking and savings accounts. There really is no maximum number of draws that are typically available to you, so you can really use this as a flow-through account. You've got to make sure you understand the arrangement that you are entering into with the lender, however, and what it does and does not let you do with the money. Now, once your drawing period ends, the payback period begins. And the term, like I mentioned, is typically 20 years, but it'll vary lender to lender. This is why you fill out the debt weapon cheat sheet so you can get the answers to these questions. When the drawing period ends, you can't spend any of the money any longer. However, that is not always the case. In the event that you have paid your home down, you might be able to again draw on it in order to, by replacing the home equity line of credit that you have. Once your draw period ends, you can start making payments. You can only keep paying against what you borrowed and no more. and your repayment term will typically be 20 years. But if you were to refinance into a new home equity line of credit at that time, provided that they're available under similar terms in 10 years, which is obviously speculative, then you're obviously able to enter into a new 10-year draw period, presumably, again, if the terms are the same in 10 years, and you would have access to that money. This is a similar argument to what we discussed when we talk about paying a property off in full, right? You can actually pay it down and then open up a new HELOC. Look, this is why we don't like to wait for repayment periods to begin in order to start paying things off. Our goal in general is to pay things down as fast as possible, as long as we're not compromising our liquidity and access to capital. You don't want to lose your entire house all because of poor planning with your home equity line of credit. And speaking of planning, it's important to choose the right debt weapon for the specific use that you have in mind. A home equity line of credit may not be the right fit for your personal needs. There are alternatives, and those can include things like home equity loans, which are amortized versus revolving lines of credit. Cash out refinances is an option. Personal loans, credit cards, personal lines of credit, business lines of credit, personal credit cards, business credit cards. There are pros and cons to all types of different financing resources and tools that are available to you. But crucial factors like the term, the interest rate, revolving versus non-revolving, really these are all among the first things that I'm going to be looking at and that are on my mind when considering the best possible tool for my particular needs, as well as for my coaching students' needs too. So what are you looking into? What loan has served you the best? Please leave a comment for me below. Would love to read what you guys are relying on in order to achieve your goals. And throw in there what you've used the tool for. Generally speaking, I am not somebody that will ever recommend leveraging in order to get into any type of consumer-based liability. Anything that is not going to contribute favorably towards the maximization of your cash flow, meaning you're earning more or it's costing you less by having it. By having it, I can earn more or I can spend less. This is not so that we can go out and buy that car we've always wanted. Oftentimes, even putting home repairs into a primary residence doesn't make a ton of sense. Yes, it might temporarily or permanently increase the value of that property, but it only benefits you temporarily, or as long as you plan on living in the home, it's not going to actually serve you during that time. What does a new kitchen do for you other than make you perhaps feel a little bit more satisfied from one day to the next? Just because it increases the value of your home, you don't realize that financial benefit until you move and sell the property. So really reconsider spending any money you have to borrow on those types of items. Perhaps it would make better sense to tuck a little away, save it, and actually spend cash reserves on that type of what you could call an investment versus borrowing money to achieve it. I only recommend borrowing money when it will create additional wealth for you. You're able to invest it into a new income stream, or you're able to pay off other very high interest types of non-mortgage related balances using a lower interest revolving account like a HELOC to consolidate that debt. But if you already have that debt in non-mortgage related balances, especially credit cards, that means you're overspending. You're spending more than you have. That means you've borrowed from a credit card company in order to make that purchase. And typically speaking, that would not be the type of borrowing I would want you to be doing. I would rather see you using low interest tools to make the right type of borrowing into investments that are paying you, that have a low risk and low cost barrier to enter. So that would be my recommendation. That's some of the generalities on HELOCs, guys. Again, leave some comments below. Would love a thumbs up. We are going to start offering complimentary coaching. Again, we're going to have some contests on that coming up in the near future, so make sure you're a subscriber to the channel so that you can stay plugged in. Would love for you to be the winner. I will be doing that coaching myself personally, and I'd be happy to get eyes on your road mapping process so that you can build a plan to get yourself exactly where you want to end up a lot more quickly. So I'll look forward to those calls. In the meantime, make sure you stay plugged into the channel. Make it a great day today and keep on cash flowing. Take care.